Oh my God, it is finally here. The week we've been waiting for a long time. More specifically, Wednesday, September 18th, around 2 p.m. Eastern Time, the Federal Reserve is going to start its cycle of cutting or reducing short term interest rates. The last hike was in July of 2023. So for the last 14 months, the Fed has kept short term rates high. Now, why am I making this video? Because every time we go through this, a lot of confusion in the markets, especially by the media and consumers. And in this case, if the Fed is going to cut 0.25%, which we think that's what they're going to do on Wednesday, many people are going to say that mortgage rates were cut by 0.25%. That is not true. Let me explain how this works. My name is Jeff Garber. I'm a mortgage loan advisor, and I hope this video helps. So the Fed controls what are called short-term rates. And that would be rates like variable credit cards, home equity loans, student loans, car loans, things of that nature. It is not long-term 30-year fixed mortgage rates. Now, while they don't control exactly what happens to mortgage rates, the actions that they do and the things that they say are going to all dictate which way mortgage rates go. Now, let me just explain. The Fed has two mandates that they go by. One is to keep inflation low, and they've done a good job of getting inflation back down to closer to the target rate where they want it to be. And number two, their second mandate is to keep unemployment low and to keep the jobs market strong. Now, because rates have been kept higher for longer, we're starting to see cracks in the labor force, meaning unemployment is starting to tick up and job growth has slowed. So the Fed now has to take action. So what do? Well, they're going to start a series of cuts. And what do those cuts do? Cuts make things cheaper in the economy, which promotes spending. And so when the Fed cuts rates, as they do this over time, things become cheaper, people spend more money, and the theory would be more jobs are created, unemployment is low, and that helps keep the economy where they need it to be. However, on the flip side, when the Fed cuts rates, that could also be inflationary, right? Because when people spend more money, it could cause companies to raise the price of the goods and service they offer because people are spending more money. So Fed cuts could also be inflationary. Now, in this case, we're looking for the Fed to cut rates. And not only that, but if you look at this chart, what you're seeing here are mortgages that trade in the market. And as these go up higher, that means mortgage rates are actually coming down. So you can see since July, we've been building in, we've already baked in the fact that we know that the Fed is going to start cutting rates at some point in time. And because of that, we saw mortgage rates starting to improve already. So we've already improved more than 0.25%. So we've kind of baked that in. Now, if the Fed does cut by 0.25% Wednesday, nothing might happen to mortgage rates because we've already baked it in. Now, if they decide to cut 0.5%, well, you know what? We might get a rally in the mortgage bond market because that's a bigger cut than we thought. And that might help rates as well. We might actually get a little rally in the bond market and rates could come down a little lower. Now, regardless of what they do, all right, there's going to be a Fed press conference with Chair Powell at 2:30 p.m. Eastern, and we're going to be listening to exactly what he says because he can move the markets not only by cutting, keeping rates the same, or raising rates, by what he says. And so if he says favorable things, meaning if he feels that the jobs market and unemployment aren't where they want them to be, and they're going to continue to reduce short-term rates, then the bond market may like that, and mortgage rates could come down even further. On the other hand, if he has a different message and it goes against what the bond market was looking for, well, that could cause the bond market to start to sell off, and then rates could get higher. So the whole point here that you need to know, a couple things. Number one, if the Fed cuts, which they probably will on Wednesday, more than likely 0.25%, maybe a half. Most people are saying 0.25%. That does not mean mortgage rates just came down 0.25%. They've been coming down in anticipation of this cut. But if they do cut maybe more, That could excite Wall Street and the bond market, which could help rates come down even further. And we're going to be looking at what the Fed says in their press conference and their statements at 2:30. And that is going to dictate probably where mortgage rates head as we get further along. So I hope this helps, and feel free to share this video, and I will catch up with you later in the week, and I will break down exactly what the Fed did, what they said, and what we expect rates to do from that point forward. Hope you have a good one.